So as Mr. Carrion mentioned, we will now move on to specific details of what brings us here. And for that, we welcome Mr. Edgar Rios, attorney at law and a member of Piedra Antoni Mendez and Alvarez. Mr. Rios is an expert on Acts 20 and 22 and he has been a key partner to many people and businesses that have come to Puerto Rico. His practice focuses on international tax matters, inbound and outbound corporate reorganizations, registered investment companies, structured investment vehicles, and other complex federal, international, and Puerto Rico tax law matters. Mr. Rios Mendez earned his Juris Doctor degree from the University of Puerto Rico School of Law and his Master of Law degree from New York University School of Law. He was admitted to the bar in the Commonwealth of Puerto Rico and the U.S. Court of Appeals for the First Circuit in 1998 and to the U.S. Tax Court in 2002. Please welcome Mr. Edgar Rios.
Good morning. As it was said here, I'm a partner at Piedra Antoni Mendez and Alvarez, and we're very excited to be part of this event. I'm going to start, I'm going to talk about Act 20 and 22, and as Richard Carrion was saying a minute ago, we have many incentives in Puerto Rico. Act 20 and 22 are the ones that probably brought you here, and we're going to focus on that. But rather than speaking about the benefits of Act 20 and 22, I would like to talk first about the foundations of Act 20 and 22. Normally, when I have a client or a prospective client on the line, typically what I hear is just too good to be true, right? And in order to understand why it works, I would like to take you to the basics, and then we'll talk about the benefits. Because the benefits probably all you know is low rates, 4%, but I really want to focus on why it works and the interaction between the United States tax laws and the Puerto Rico tax laws, which will help you understand why this Act 20 and 22 will provide those benefits that make Puerto Rico very attractive from a tax standpoint. I'm going to start talking about individuals, and then we'll talk about entities. One of the first rules that some people sometimes are confused is that as you all are that reside in the United States or are U.S. citizens, you're subject to worldwide taxation, right? So no matter where you go, you're followed by U.S. federal taxes. Puerto Rico has the same rule. If you're a bona fide resident of Puerto Rico, if you're a U.S. citizen, or even if you're not a U.S. citizen and you reside in Puerto Rico, you're going to be subject to worldwide taxation. The difference is that that is not available for mainland residents is Section 933. Section 933 is the one that provides that if you're a bona fide resident of Puerto Rico and you derive Puerto Rico source income, you don't have to pay federal taxes on your Puerto Rico source income. So it's very important to understand what constitutes to be a bona fide resident of Puerto Rico and what Puerto Rico source income is under the federal rules. Those are the two key components in order to be able not to be subject to U.S. federal taxation. A bona fide resident of Puerto Rico is one that meets three criteria. One is fiscal presence, the other one is tax home, and the third one is closer connection. I'm going to talk briefly about the three. Fiscal presence. There are four ways of meeting fiscal presence. And this, again, when you see the site, you will see that it's a site to the IRC regulations. So these are federal regulations. So this is highly regulated. There are tests that are described in the regulations, in the federal regulations, that you need to meet in order to be considered a bona fide resident of Puerto Rico. And these regulations came about in 2009. There were a lot of abuses of people claiming that they resided in the possessions in order to avoid taxes. And basically, the response to those abuses were these 937 regulations. So let's talk about fiscal presence. Fiscal presence, four ways of meeting fiscal presence. Really, for people that have not lived in Puerto Rico, only two relevant ones. So let's talk about the two relevant ones. A lot of people talked about the 183 days in Puerto Rico. So one way of meeting fiscal presence is if you are physically present in Puerto Rico for 183 days. Obviously, people travel, right? So one important thing is traveling. When you travel, the day that you depart from Puerto Rico, that will be counted as a Puerto Rico day. The day that you arrive in Puerto Rico, that will be counted as a Puerto Rico day. So that's very important for you to know that those will count as Puerto Rico days. If you're outside of Puerto Rico, the U.S. or anywhere else, that's not counted as a Puerto Rico day. So it's very important travel to Europe, so it's not traveling to the United States. If you travel, if you're physically outside of Puerto Rico, that's not going to be counted as a Puerto Rico day. The other way of meeting physical presence for people that are coming from out of the United States is that one way of meeting physical presence is if you're less than 90 days in the United States. So if you're a person that travels to Europe and you do a lot of business outside of the United States, you can meet physical presence, but just being less than 90 days in the United States. You will check physical presence. Now, tax home. Tax home, which is the second test, is very objective in the sense that where's your principal place of business? Where's your principal office? If your principal office is Puerto Rico, you will meet tax home. The test itself, when it talks about principal office, obviously allows for you to have a different office. So you don't only have to have a Puerto Rico office, but your principal office needs to be Puerto Rico. How that is measured, there's no bright line rule as which one is your principal office. Obviously, one way of determining that, it could be, how many days you spent in the Puerto Rico office vis-a-vis your non-Puerto Rico office. But there's no bright line rule with respect to, which one is which. But you have to be able to claim that Puerto Rico is your principal office. Closer connection. Closer connection, as the test is named, means that you need to have a closer connection to Puerto Rico than anywhere else. With respect to closer connection, basically the regulation has many criteria in order to try to determine which one is, if you have a closer connection to Puerto Rico than New York or California or Spain, wherever you're coming from. Closer connection, for example, the criteria will look at where is your family located at, what are your personal belongings, are you registered to vote in Puerto Rico, are you a member of clubs here in Puerto Rico, where are your bank accounts, your brokerage accounts. If all that is heavily cited to Puerto Rico, then you will make closer connection. So normally people that come down and decide to become bona fide residents of Puerto Rico, they would like to do the different things that are objective, which are to get your driver's license in Puerto Rico, be registered to vote in Puerto Rico, become members of clubs in Puerto Rico. And it's a very subjective test, but it's important. What it tries to convey, closer connection, is that Puerto Rico truly needs to be your home in order for closer connection to work. And again, once you pass those three tests, you have the one key element about Section 933, which is you are a bona fide resident of Puerto Rico. Now, what you also want to know is what is Puerto Rico source income? Because that's the one you get to exclude from federal taxation. And the sourcing rules, you again will have to look at the sourcing rules in the United States in order to determine whether this is Puerto Rico source income or not. So these are not Puerto Rico rules, these are US rules that you want to look at in order to determine if this is Puerto Rico source income, whatever you're deriving. Service income is fairly easy. Service income is the place where the services are rendered. And that one is key for Act 20, which we'll discuss in a bit. Because if you establish a company in Puerto Rico and the services are rendered in Puerto Rico, management services and things of that sort, then because the services are rendered in Puerto Rico, that will be Puerto Rico source income. Because the sourcing rule is where the services are rendered. Capital gains, as a general rule, and there are a few exceptions, but as a general rule, capital gains are based on residence. So it's a very good thing. For example, if you're holding Microsoft and you live in Puerto Rico and you sell Microsoft, even though the issuer of the position is a US company, the gain is going to be sourced to Puerto Rico because you reside in Puerto Rico. So that's the general rule with respect to capital gains. And we'll talk about some exceptions just so you become familiar as to the intricacies of this rule. So it looks at the place where you reside. Swaps, very important. A lot of sophisticated people in the room. For example, if you swaps, the rule under the US code, under the regulations, 863-7, is that for swaps, you look also at the place where you reside. So for example, if your counterpart is in the United States and you're in Puerto Rico and you get a swap payment, that will be Puerto Rico source because you reside in Puerto Rico, regardless of where your counterpart is located at. So swaps is very important because you get to use swaps for basically imitating or mimicking other streams of income that typically are problematic. Dividends. Dividends is one that you look at the place where the payor resides. So for example, same example, you have Microsoft, you get a dividend from Microsoft, that will not be Puerto Rico source because Microsoft is a US company. So typically if you receive that directly, you have an issue. We'll talk about certain structuring can do, but normally you look at the place where the payor is sitting in order to determine the source of the dividend. Same thing happens with interest. Interest is based on the residence of the payor, not your residence, but the residence of the payor. So you have to be aware of those rules in order to be sure that some of those things will not be covered by Section 932 unless you are in a structured vehicle. Let's talk about corporations. Puerto Rico corporations under the U.S. Code are treated as foreign corporations. So as any foreign corporation is not taxed in the United States unless it's engaged in a business in the United States or unless it's deriving passive income from the United States. So normally if you have a Puerto Rico corporation operating in Puerto Rico, that will not suffer any U.S. taxation, even though Puerto Rico is a U.S. possession. And what this slide is trying to point out is that once you're able to avoid or escape U.S. taxation, then basically the only consequence that you have to worry about is the local consequence, because Puerto Rico does impose taxes. So it's very important if your activity is covered by a tax incentive law in order to determine whether you're going to be in an advantageous position. The state, because Puerto Rico, for example, for individuals does have regular rates. If you're not in a tax advantageous scenario, you're going to be paying regular taxes. Puerto Rico income tax is 33%, sales and use tax 7%. We have a state and gift tax of 10%, and we have real estate taxes between 8 and 10%. So they're real taxes. This slide, I just want to quickly point this one out because some people have asked me about state taxes. If you're a U.S. citizen and you're residing in Puerto Rico at the time of death, it's very important to understand that Puerto Rico is a soak-up tax with respect to state taxes, meaning that Puerto Rico will impose a state tax that the U.S. will allow you to credit. So whatever you can credit in the U.S. is going to be your Puerto Rico state tax. So you truly don't have to worry about if you're a U.S. citizen that decides to move to Puerto Rico and you die in Puerto Rico, then Puerto Rico is just a soak-up tax, and you don't have there's no detriment for you if you live in Puerto Rico at the time of death. Let's talk, and as I said before, in the case of entities, Puerto Rico does have regular taxes. 39% is the maximum tax rate, and there are other local taxes, municipal taxes, property taxes, between 8 and 10%. But the important thing is whether you're covered by an incentive law in order to escape those taxes that Puerto Rico imposes. So again, the analysis has to be, am I a resident of Puerto Rico? Do I have a foreign corporation that is not subject to U.S. taxes? And once you escape the U.S. taxes, then you have to worry about local taxes. And if your activity qualifies as an incentivized activity under the incentive laws, then you have the benefits. Act 20. Act 20, as you have all heard probably at this time, Act 20 does provide for 4% income tax rate, 100% exemption on distributions, and it does cover pretty much, it exempts other local taxes. Act 20, as it was mentioned before, is the law for export services. So you establish a company in Puerto Rico and you provide services to markets outside of Puerto Rico, you will be covered by Act 20. All the service income derived for that activity is going to be subject to 4%. And you get a tax degree of 20 years. And the advantage of having the tax degree, which is the first line in this slide, is that once you get a tax degree, that becomes a contract between the Puerto Rico government and your company. And even if the law changes, gets repealed, modified, you're covered by your degree. And basically the degree is going to provide these same benefits. The degree is going to recite these benefits, and you're going to be able to enjoy those benefits for 20 years, regardless of changes. What is covered under Act 20? As said before, services for markets outside of Puerto Rico. Last point is that this law expires in 2020. Typically, all these incentives laws will have a period of life in order to determine whether those laws work or not. And normally, a new law will be adopted, assuming that this law did work and created economic development. So the expiration is 2020, which will mean that, let's say, for example, you get a degree in December 31st, 2020, you will have a degree all the way until 2040. So it's not that the degree system expires in 2020, it's just that you have to go and apply for before December 31st, 2020. Eligible services. Basically, I I just wrote down 3 of the eligible services, but the law provides for a long release of services. And pretty much the intention is to try to cover all lawful activity that is service-oriented, right? So, for example, consulting services will be covered, professional services such as legal, tax, accounting is covered, investment banking, and all financial activities that are service will be also covered by Act 20. And the Secretary of Economic Development and Commerce also has the power under the law to declare another service as being eligible. So there are opportunities to, if you don't find your service in Act 20, in the long release of money, does not mean that you cannot be covered. You have to apply for it, and the Secretary of Economic Development and Commerce does have discretion to declare that as an exempt service. Okay, I think I'm going to pass this. There are 2 examples for Act 20. I'm going to pass this one because this one is more targeted to a local enterprise. I'm going to cover the next one, which will be a company deciding to establish a business in Puerto Rico. Let's say that Company B is engaged in warehousing and distribution. If you're in that business, something like this will apply to you, but if you're in the private equity business, you can't consider whether your portfolio company should be moved to Puerto Rico in order to basically improve the returns on that portfolio company. Let's say you're in private equity and you have as a portfolio company an entity that does warehousing and distribution out of Florida, and is thinking about Act 20, is thinking about whether you should continue to do this business out of Florida. And let's say Florida, for example, let's say that the company has incremental revenues or is deriving revenues in Florida of $1 million. Just consider state and federal taxes. The company will pay $410,000 in taxes. It will have a net revenue of $590 after taxes. And if it is operating as a corporation, it will have the additional, the additional issue of paying dividend taxes and the Obamacare and so forth, and it's going to end up with 449 out of the million that it generated. So if that same company were to operate in Puerto Rico and derive that same million, it will pay just 4%. So it will pay 40,000, right? And then it's going to have an after-tax profit of 960, which is important in the sense that that 960, if you compare that to the 590 or the 449, is very significant. It's basically more than half in one case and close to half in the other case. What is important also, and it's not illustrated here, the dividend withholding tax, which shows 0, that's because Puerto Rico will not impose any dividend withholding tax. But let's say that your owners do not reside in Puerto Rico, so they still have to worry about the U.S. consequence of that dividend. Dividends from a Puerto Rico corporation are qualified dividends under the U.S. code. So you get to enjoy the 20% if you get a dividend from a Puerto Rico company. So let's say that you pay 4% at the entity level, 20% on the dividend if you're residing in the U.S., and you have to pay the Obamacare, assuming you have to pay the 3.8. So we're talking about a tax exemption. Typically, it will take around 90 days to consider eligibility. The people from the Office of Industrial Tax Exemption are here, so they will, I guess they will bless that it will take 90 days. But the important thing about the 90 days is that you don't have to wait to start your activity for 90 days, because the important thing will be filing the application. Once you get your tax decree, the benefits will be retroactive to the time the application was filed. So you don't have to wait for 90 days. So even if it takes 90 days, you're going to be covered from the day the application is filed. The policy as of now is that you have to derive at least 3 employees in Puerto Rico. There's no specification as to which type of employee. So secretary will count, a manager, an accountant, but you have to target 3 employees in order to be covered under Act 20. Basically the other requirements are you have to file an annual report in order to just let the Office of Industrial Tax Exemption know about your employment compliance and how much activity you're generating in Puerto Rico, just so they can keep track of what is of how well the companies are performing in Puerto Rico. The other law is Act 22, and I'm gonna quickly jump in Act 22. Act 22, different than Act 20, is more targeted to individual investors. It's more targeted to a benefit at the individual level rather than a benefit to a business, although a business deriving capital gains, such as a private equity firm, will benefit from Act 22. Let's say I'm gonna start talking about the benefits of Act 22, and then we'll provide an example that will explain the third bullet point, which is kind of complicated. So I'll just go to the example in order to explain the third bullet point. But in essence, what Act 22 does is that it provides 100% exemption from Puerto Rico taxes with respect to interest, dividends, and capital gains. So those three income streams are the ones that are favored under Act 22. Now, as we discussed at the beginning of the presentation, it is important to determine whether you are taxed in the United States with respect to those income streams. Because if I give you 0% taxation, but you're still subject to U.S. taxes, then it's of no benefit to you, because you're still subject to U.S. taxes, right? So the important thing will be how Act 22 interacts with the federal system to see if you can truly enjoy the 100% income tax exemption. Basically, the exemptions provided under Act 20 will last until 2035. So, and you also get a tax degree. So if you get the benefits under Act 22, you also be protected. So if Act 22 is repealed in the future, you still will be able to enjoy the benefits of Act 22 if you get your tax degree. The way it works is that, let's say you get to Puerto Rico in 2030, then you will have just 5 years of benefits. If you get it in 2020, then you'll get 15 years of benefits. So it's not a fixed period of time of benefits. It just depends on when you move to Puerto Rico, how long you're going to enjoy the benefits under Act 22. Okay, sorry, press the wrong button. Who can benefit from Act 22? It's basically anyone that moves to Puerto Rico that was not a resident of Puerto Rico for the last 15 years. But that last 15 years is basically a snapshot. If you were not a resident of Puerto Rico from January 16, 1997 through January 16, 2012, you qualify for Act 22. So there's no balance sheet test, no compromise of making investments to Puerto Rico or from Puerto Rico. In order to qualify, you have to apply for the tax degree, and basically the threshold or the hurdle that you have to pass in order to qualify is that you were not a bona fide resident of Puerto Rico for that period of time. Benefits, as I said, expiring December 31st, 2035. And let me back up just to put the facts of this example. The facts of this example is I have a resident of New York City. I have Joe, who resides in New York City, and he's considering to move to Florida, right, in order to avoid the state taxes and the city taxes of New York City. And but he also is going to consider Puerto Rico for purposes of deciding which one is the best jurisdiction. And let's say that I'm going to get closer because this is very small, but I'll try to do my best. Basically, in this chart, and let me mention to you that you've got a goodie bag, and that goodie bag will have a USB that will say Pietro Antonio Mendez and Alvarez, and the presentation will be in that USB. So all of you will have these tables, and you can see the details of this table later on. But basically, if this person were to live in New York City and is deriving two types of income streams, ordinary income, let's say that's interest and dividends, and capital gains. Is deriving $1 million in interest and dividends, is deriving capital gains of $1 million. Living in New York City, obviously, it has the federal tax, the state tax, the city tax, and when you combine all those, even though the capital gains are tax favored in the federal system, you still end up with a combined rate of 45.63 in this example. 45%. Though Puerto Rico will grant me a 0% tax, I still subject to U.S. tax on my ordinary income in this example. So I do have federal taxes imposed on that ordinary income. However, capital gains, I'm able to enjoy the benefit of the sourcing rule that is residence, and because I reside in Puerto Rico, I escape federal taxation with respect to my capital gain. And I truly enjoy the 0% taxation of Act 22, and therefore I have 0% tax on the capital gain if I'm a bona fide resident of Puerto Rico. Basically, under this example, Puerto Rico combined, you will pay 22.1. So even if you have a portfolio that still is subject to U.S. taxes, and you have capital gains that you're deriving, the combination of those will be able to lower your tax burden from, I believe, 45.6 in New York to 22.1. And when you compare that to Florida, Florida that still is 42.6. So Puerto Rico basically allows you to cut in half or more than half your tax burden by having those two income streams. So Act 22 is very powerful in terms of basically providing you relief of those federal taxes. I'm going to give this example, and because some people have asked me, what if I have fixed income? And again, I said at the beginning that fixed income, it depends on the place where the payor is located at. So fixed income, typically, if I have an investment in U.S. fixed income, that is going to be U.S. source, and I'm going to continue to be subject to U.S. taxes. But let's say that one of the local brokerage houses decides to create a registered investment company that will gather some of you together and then will replicate the type of portfolio that you would like. So that investment company will invest in fixed income in the United States, and it's going to have Act 22 as owners. Act 22 individuals, people that move to Puerto Rico and are covered under Act 22. Under that example, what is the right move? We'll go to that. Right move. If you were in the United States, and we're talking about federal now because I'm presuming that it's going to get worse with state tax and city tax. But let's take, if you were residing in the U.S. and you're getting your fixed income, taxable fixed income, you're going to end up paying, assuming you're in the highest bracket because you have other sources of income, right? On 1 million you will not hit the top bracket, but you have, let's say you have other sources of income and then you hit the top bracket of 39.6. You end up on that million of fixed income paying $396,000, and you basically are left with the remaining 40.4. If you were to do the same in Puerto Rico through that Puerto Rico registered investment company, what will happen is that the Puerto Rico registered investment company organized in Puerto Rico is considered a foreign corporation for U.S. purposes. A foreign corporation that is deriving interest income from the United States, if it does correctly that and buys a registered obligation, it will pay zero taxes in the U.S. So a foreign corporation will be able to extract that interest income with 0% taxation in the U.S. So that million is going to reach the Puerto Rico registered investment company paying zero taxes. Now the Puerto Rico registered investment company is going to turn around and get you a dividend. And assuming there's enough people of you, 10 or more, in that registered investment company, for sure that dividend is going to be Puerto Rico source income, and you're going to have a 0% taxation on your dividend. So in theory, both for the cost of managing the fund, everything else, that income stream will reach Puerto Rico with no tax leakage and no taxes at all, and it will enjoy a 0% taxation. Let's talk about. I want to move forward just to. Well, let me talk about this example, and then this is pretty much the end of my presentation. And it's very important for you to understand this one, and I get a lot of questions with respect to this one. Obviously, the rules in the U.S. were crafted in a way that you cannot basically take all your positions, move to Puerto Rico, and basically sell your positions, declare those as being Puerto Rico source, and not pay any taxes to the federal government, not pay any taxes to Puerto Rico, and then go back to the U.S., right? So in order to avoid that cleansing, basically what the rules will provide is that if you have a position that you were holding before you became a bona fide resident of Puerto Rico, the gain accrued before you became a bona fide resident of Puerto Rico is going to be tainted for 10 years and subject to U.S. taxes. Any gain that accrues after you become a bona fide resident of Puerto Rico, then you can enjoy the 0% taxation. No taxes for federal taxes and no taxes to Puerto Rico. So let's talk about that built-in gain piece that you have before you move to Puerto Rico. That piece that you have as a built-in gain before you move to Puerto Rico, what's going to happen to it, let's take this example. There's an example, and I talk about this public traded position. You bought that in 2006. It was for 40. It was worth 100. And then you moved to Puerto Rico in 2012, and you sold the position in 2018 for 200. So you sold the position before you were residing in Puerto Rico for 10 years. You were in Puerto Rico for 6 years under table here will show you that the non-Puerto Rico built-in gain, the gain that gets tainted in this example is 60. The Puerto Rico gain in this example is 100. So therefore, what's going to happen, just considering federal taxes, what's going to happen is that that U.S. tax is going to be 12, and without counting Obamacare, because we don't know what's going to happen to that. But let's say that it's 12, so you're paying 20% of your capital gain. Then what will happen is that Puerto Rico will also tax that part of the gain, because now you're a bona fide resident of Puerto Rico, and you're subject to Puerto Rico taxation. So you're going to pay 6 on that, because the rate in Puerto Rico is 10%. But the U.S. will allow a foreign tax credit for the part that you pay to Puerto Rico. And again, we're talking about the built-in gain that accrued before you became a bona fide resident of Puerto Rico. That's the one we're talking about. So you have 12 in U.S. taxes, 6 in Puerto Rico. The U.S. will recognize a credit to whatever you pay to Puerto Rico, and you're going to be paying 6 to Puerto Rico, 6 to the United States at the end. So it's basically you're cutting 2 checks, 6 to Puerto Rico, 6 to the U.S. by virtue of the foreign tax credit. So you're not worse off. Basically, you pay 12%. You pay $12 in this example, which is the U.S. tax. So you're subject to the highest rate. With respect to the 100, which is attributable to the period that you were a bona fide resident of Puerto Rico, you're not going to pay anything to the U.S., nothing to Puerto Rico under Act 22, and the 100 will be taxed at 0. So the important thing about this rule is that you have to consider how much it was accrued before you became a bona fide resident of Puerto Rico, because that's going to continue to be subject to U.S. taxes. And if you cannot wait the 10 years, then that's going to be the situation. This is the last thing this is the last thing I want to point out, and in order to clarify a lot of misconceptions, that the rules with respect to how much of the gain was attributable to your U.S. residency versus how much was accrued to while you were a bona fide resident of Puerto Rico are different if you're talking about marketable securities and if you're talking about privately held non-public securities. When you're talking about marketable securities, the way you measure the gain is easy. You do mark-to-market. Before you came to Puerto Rico, you check how much it was worth. You write it in a piece of paper. You wait. You have some evidence in case something happens. You will know how much was attributed to that period of time. In case of non-marketable securities, the issue is that there's no market. So in order to determine that, basically what the regulations provide is what is called a rule of convenience, which means that in the case of non-marketable securities, you will do it by holding period. So if you bought a position and you were residing in the U.S. before you became a bona fide resident of Puerto Rico, you held that position for 3 years, and then you were, in order to make this easy, while you were a bona fide resident of Puerto Rico for 3 years, you sell the position, then that gain is going to be split 50-50 with respect to a non-marketable security, because it goes by holding period. It doesn't even matter if the position was upside down before you came to Puerto Rico, because it's just a fast rule. So let's say that it had no built-in gain, and then you move to Puerto Rico, and you sell the position after you move to Puerto Rico, you will do it by holding period with respect to privately held positions. So that's very important to understand. With respect to marketable, it's easy. And that concludes my presentation. Thank you.
To the bottom line, you should consider the advantages of Puerto Rico's 5-point business star. Point 3, attractive tax incentives.